First of all, our thoughts are with the families and communities that have suffered casualties from the coronavirus. No one can predict precisely the pace and duration of the contagion. The apparent success of containment measures in China raises hopes that by the turn of the month, contagion will flatten out. However, world population ex-China is more than 4 times that of China, and it isn't clear that restrictions will apply as strictly everywhere. It is too early to estimate the impact on world growth. The longer the shock, the larger the impact. These charts highlight the sudden stop of the Chinese manufacturing sector. There is no doubt that the Chinese government will deliver a strong policy response in the hope of starting a V-shaped recovery. Unfortunately, policies aiming at supporting demand cannot fix the supply side of the economy. Governments and markets face a catch-22 situation. Strict health measures aiming at social distancing are necessary to help the medical system cope with the crisis. But those measures amplify the shock on the economy. The initial market response to fiscal and monetary policy is therefore smaller than usual, but action there are still greatly needed to contain the shock on demand. Once the virus fades out, they will support a strong turn in investor sentiment. We do expect bold policy measures, but there is less fiscal and monetary room than in 2008. In the near term, the key risk is that companies that so far had access to ample and cheap funding fail to access liquidity. As we speak, some segments of the markets, especially risk-free assets, are already pricing a severe recession. The sell-off in equities has been large, but it started from a high level of valuation. The earnings recession will aggravate in 2020, and until we see a slower contagion of the virus or spectacular policy action, we need to be cautious. European equities have lost from their mid-February high. This is even worse than in 2012 and 2016. Losses were far larger in the 2008 great financial crisis, of course. On a beta-adjusted basis, credit has had the worst run in this crisis. Given the fear of defaults, high-yield markets will not turn before equities. But re-entering investment grade makes sense if, like us, you believe that the ECB will scale up purchases and provide ample liquidity to the system. Longer term, this crisis will present opportunities, as relative valuation has got sharply skewed against risky assets. But there is a pattern of repeated market shocks here. In the negative yield world, we need to get used to slow risk rallies followed by large corrections. More than ever, hedging needs to be at the core of investment strategies. We do not think 2020 will be 2008 redux, but this crisis will leave marks on the global economy. Globalization, already exposed to trade tensions and automation, will be further questioned. In these tough times, there is a silver lining. Carbon emissions are down sharply. We must make sure that the collapse in oil prices does not come in the way of climate and energy transition.